It's a brilliant, brilliant event, and you'll come away with lots of new ideas and a better understanding of this incredible exponential world. You get to speak to the smartest people like you trying to figure this out, but also the people on stage. They're the experts. So we get all of that, all in one place, in Singapore. What more can you ask? See you at Token 2049.
Welcome to another edition of Macro Mondays, or should I say Macro Tuesdays, Andreas. We're obviously now publishing for the American media realvision. That means we have to conform ourselves to US holidays, such as Labor Day. So we're recording and publishing this on Tuesday as something new.
Yeah.
We're getting all across the week now.
Yeah. But we worked yesterday, just in full transparency.
We did in Europe. That's one of the only times over the year where we work more in Europe than America, perhaps. My name is Mikkel Rosenvold. With me, as usual, I have Andreas Steno. We're the team here at Steno Research. We're going to give you a little sneak peek into our thinking based on a great article you wrote on Sunday, Andreas. Look into our regime model, which we're going to turn into more of a weekly thing now, and look a little bit on oil markets. But Andreas, since the title is fake, Macro Mondays, since it's not Manda Mondays, the theme of this week is faking. We're going to talk about the fake first half of the year rebound, or at least a head fake, and I have another news for you. This whole inflation wave over the past years, completely fake. Just look at this chart. I mean, this is at least one market where we haven't seen any inflation, more or less. This is the cocaine price you posted on X over the past 13 years, more or less back to the index price, while the purity has gained significantly. So this is one market that hasn't seen the inflation wave of the past few years.
So there's actually one serious comment to this. When you look at how for example, the Statistical Bureau looks at inflation, when the purity increases while the nominal price is stable, that's actually deflation.
Yeah.
And one practical example outside of drug space is the price of an iPhone. Yeah. The price of an iPhone is actually going up nominally, but since the quality measured by the amount of data storage, the quality of the camera, etc., goes up even more. Mm-hmm. It is recorded as a disinflationary impact in the inflation basket. But if you're stuck at nominal salary levels, it gets more and more difficult to buy an iPhone, even though the Statistical Bureau tells you that it does not.
That's probably the same case with cocaine. Enough about that. Enough about that. No analysis on that. Andreas, I want to talk this week about what you call the head fake business cycle. I just want to rewind time a little bit, about half a year, to back in March, where you wrote this article, the head fake reflation. Just take us through what were your thoughts back then?
So allow me to read out aloud from the article here. After having traveled to London last week, I'm left with a vibe of a head fake reflation narrative. We're truly late in the cycle, which opens the door for super interesting bets. And the point here was that at the time, it was still pretty consensual to say that the US cycle was recessionary. It was something that a lot of people had as their base case for the full year of 2024, that we would get some sort of at least very significant slowdown or a potential recession scenario. And then as we entered the year, we had a clear buildup of momentum in manufacturing. We had a clear buildup of momentum in the inventory cycle. And I think we're now getting more and more evidence that it was some sort of head fake in the business cycle again. And we've seen plenty of head fakes since 2020. The business cycle has been fake in many ways, both up and down since the pandemic started, because of political decisions, because of extreme geopolitical tension, and because of tariffs. And I think the key word to understand the business cycle of 2024 is tariffs.
And when you say tariffs, we're of course talking China.
Yes.
So I believe, Andreas, we're getting a little more insight, or perhaps educating ourselves a little bit more now that we have more data on what has happened in China over the course of 2024.
Yeah.
We've been talking a lot of the hoarding almost of copper.
Yes.
What we knew about the manufacturing cycle. What do we know now?
Well, I think it's relatively safe to say that some sort of front loading happened ahead of the tariffs implementation. And now I'm talking about the tariffs implementation, both from the Biden administration, but also subsequently from the European Union. One example is the chart we have on the screen with the running monthly copper export from China. And as you can see, we had like a 3-4 standard deviation outlier during the latter part of the spring and into June, probably because tariffs were implemented just after that. So the point here is that China saw the opportunity to export a lot ahead of the tariffs. They probably also had a lot of orders from us in the West ahead of those tariffs. And to take a practical viewpoint on this, it makes a ton of sense to get a lot of cars shipped to Europe and to the US before the implementation of tariffs. Because if you have a build your dream car in a European inventory, by the time of the tariffs implementation, it's obviously not hit by the tariff. You need to cross a border, right? And I mean, just based on anecdotal evidence, it's still possible to buy Chinese cars without the added tariffs because they had them in inventory ahead of the tariffs, right? So I think that's quite clearly what happened. We're talking about extreme observations here. If you take a look at the copper exports again, we're talking like 3 times or maybe even 4 times a normal month, just ahead of the tariffs implementation. While we're now seeing the other side of that coin, once the tariffs are in place, once you've built up the inventory to try and cope with this situation, you obviously need to export less.
Yeah. It's finding a new equilibrium, essentially.
Yes.
Yeah.
And given that we've seen that buildup of inventory ahead of summer, given that the economy is not doing overly well in the West, it may be a major issue for the Chinese momentum now, because they obviously gained a lot from this export momentum ahead of the deadline, so to speak. And now it seems like they're struggling with their economic momentum again.
You want to unfuck your shit? This is live.
Yeah, that's being recorded. Hey, listen, if you want to unfuck your future, then come and join us in the Real Vision community. Incredible platform, amazing content, some of the smartest people in the world, and amazing tools. And guess what? It'll cost you nothing. Come to realvision.com. I'll see you there, and let's help you unfuck your future.
We have one of our favorite charts here, one of my favorite at least, the air pollution in Beijing, because that's, at least that's the way we see it. It's one of the only observations that cannot really be tampered with by the authorities.
Well, yeah, yes and no.
I mean, it could be potentially.
They can obviously take a decision to try and bring down the pollutions. They obviously have a plan to bring down pollution. So we need to consider that. So what we do is that we detrend the time series. We obviously take into account if they publish official statements on their attempts to bring down the level of pollution over Beijing and other industrial centers. The point here is this is a detrended series, right? So we're looking at the momentum outside of the trend towards a cleaner airspace, basically. And we've seen honestly, a very dramatic setback for the economic momentum in China gauged by this air pollution measure, essentially since midsummer, especially towards the middle of July into August, etc. And I think we're starting to see some of the spillovers to the West as well, with some of the negative key figures we've seen in the US. And it's all a symptom of the same, that we did build up a lot of, you can almost call it excess capacity ahead of that tariffs deadline. China is no longer exporting as much simply because there is no need to. And the Westerners, they're buying the stuff that the Chinese exported ahead of the deadlines. So this is something to bear in mind, given that we already have a pretty nasty September seasonality to look into. What we've seen from the get-go of the week is a very weak market in everything that's linked to China, and both in commodity space, to a certain extent in cyclical equities and so on and so forth. So the market is also starting to catch up to this now. We saw a pretty decent commodity rebound alongside that front loading of activity. Now we'll see the other side of that coin.
Yeah. So the question here obviously would be logically that after this this quick build-up of inventories before this deadline and quick export bubble, you have a decrease. Where's the new equilibrium going to be? Is China also being hit by weaker demand from the West, or?
Yeah, I think that's a feasible scenario now. So given that you've built up inventory already, and given that the demand side is at least not improving, that's a pretty nasty cocktail, right, for China, not least. And the new equilibrium is still up in the air. I think the jury is still out on that because, I mean, when we look ahead in the U.S. economy, we simply have to factor in the geopolitical stance of the new administration. We'll get a new administration no matter what, right? Yeah. At least to a certain extent. And I'm personally not convinced that I know a whole lot about Kamala's stance on China tariffs. We know that Trump is obviously looking into this topic, probably as one of the first things that we will look into in office. So, have you heard anything from Kamala on this? Not really. I mean,
no, not very much. I think the harsh stance on China is very much bipartisan and very much commonplace in U.S. politics. The question is how far you're willing to take this. I think Trump has been very vocal about his wish to increase tariffs all across the board, also against Europe, where it seems like the potential Democratic administration may be a bit more open to talks with China. But it's still very, very early to see exactly how that's going to play out.
I think, when she announced Tim Walz as her running mate, you had a lot of discussions on whether he was pro-China, and I think that's a bit unfair to say. But
his marriage took place in China. He's visited China a lot, so he has some context there. Yeah. But I mean, it's to label him as pro-China would be absolutely wrong in my opinion.
Yeah, that's unfair.
But possibly if they were to make some sort of rapprochement to China, he could have some links, and there could be some value to that. We'll see about that. Anyway, Andreas, I just want to touch upon before we get to our weekly regime update and get even more specific on the trends we see in the market right now and more actionable ideas. I just want to touch on the ISM manufacturing, because what we're essentially dealing with here is where are we in the business cycle and which signals can you trust to gauge where we are in the business cycle. So
not the ISM.
No, that's it. So we're recording this Tuesday morning, so later in the day, a lot of you listeners will have the benefit of the hindsight. But you posted this chart that I found very interesting, where you basically push forward the credit impulse for the G3 economies 1 year, and find the link which would usually be linked to the ISM manufacturing PMI. That link seems to have broken a little bit over past years. Will we see a reconvergence of these trends, or what do you expect, or is it still too soon?
I mean, the short answer to the very tricky question is that the ISM Institute has not been able to correctly predict anything since 2021, in my opinion. We've seen ups and downs in the PMI without really seeing the same ups and downs in the economy, and they've felt disconnected, the two, for quite a while. And I think the key question now is whether this quote-unquote head fake reflation or reacceleration of the economy that we saw during the first half of the year, whether that will turnaround in the ISM manufacturing again. We've seen some signs of it, obviously. It seems like the trend is your friend after what we've seen over the past couple of months with ISM gauges moving lower. And given the credit impulse, which is typically one of the most important cyclical bellwethers for the economy, it's not really a good idea to bet on a reacceleration of the economy right here, right now. We've talked a lot about momentum building beneath the hood, but you need to have patience for that to occur. And to me, it still looks much more like a 2025 story than a story for this quarter. I think it rhymes decently well with the forward-looking indicators of the real vision macro regime model as well. That we have to be patient here to wait for like that tsunami of liquidity that responds to a soft business cycle, no credit growth, before we can truly say that the things have changed materially for the better. And for now, it rather seems like we're stuck in a low growth environment.
So while the listeners are patient for this, where can they make money in the meantime? That's our next topic, essentially.
Yeah.
We'll try and introduce, we have been touching upon our regime model for the past couple of weeks and introducing you guys to that. We'll try and make that more of a weekly thing now because we're running these
We can
models.
run it daily.
We could run it daily even. That would mean a daily show. We'll have to talk with Real Vision about that. Anyway, we want to get this in there because this is sort of the core of our thinking and our approach. And gives you a lot of actionable insights, actually. If you believe these models, that's more or less the pretext of this. But we can explain you how they work, and you make your own decisions based on that. Enough talk. This is one of our key charts. This is the outlook, the nowcast for growth, liquidity, and inflation, the holy trinity of macro in our books. We do this on several geographies. We've taken the US here. Essentially, Andreas, we are in very low probabilities for rising liquidity, rising growth, and rising inflation, all three of them. So essentially, when they're in the lower spectrum of this chart, the chance or the probability of them being on the rise is very, very low. So we're
near term, yes.
Yes. Near term. This is very, very near term. Why is this at the moment?
So let's start with liquidity, right? I mean, a lot of charts on September seasonality have made their rounds over the past few weeks ahead of us entering September, right? With negative seasonality in NASDAQ, negative seasonality in commodities, and so on and so forth. I think this is very linked to the liquidity seasonality in the dollar system. We have two major tax seasons worth mentioning from a liquidity perspective in the US, April and September. So we know that we'll see a buildup of the Treasury General Account through September due to corporate tax payment deadlines and so on and so forth. We also have a spike in non-withheld personal taxes in September, so basically wealth taxation, etc. And to an extent, that typically exceeds a couple of $100 billion over the month when you add up all of these factors. So that's a pretty nasty withdrawal of liquidity. Typically, let's say a couple of $100 billion, what's that between friends in an economy of that size? Not a whole lot, but it matters a whole lot when we are already stuck at levels that are, in my opinion, relatively close to pain thresholds for the amount of dollar liquidity needed to sort of keep the US banking system afloat. I would not be surprised to see the JP Morgans and maybe the regional banks to a larger extent complaining about the lack of reserves in the system during September. Yeah, and that's typically not something you need to celebrate from a markets perspective. So I think a lot of I got a very good question from one of our clients yesterday. Actually, he asked me, "Can you find a simple long only strategy that performs in September?"
Yeah.
And the answer is yes, you need to be long the US dollar.
Yeah.
It works more or less every time. As you can see, the seasonality is abysmal in gold. Yeah. It's abysmal in silver, at least on average. It's not good in equities, especially not over the past years. But it's strong in the DXY. So basically the dollar index versus some of the G10 peers, right? So I think there are reasons to expect this seasonality pattern to unfold itself again. And I think there are reasons to expect a stronger than usual seasonality pattern in September this year.
Very interesting. Just touching back on our models, obviously, as I mentioned, with all three indicators being in very low probability of being on the rise, it means we are in what we call down territory. I know this chart may be a little bit confusing to look at, but essentially it maps out the probabilities of each of the regimes that are defined by rising or falling liquidity, inflation, and growth. And right now we're seeing the purple line being the most prominent one at 65% probability right now at down, and that plays heavily into how you should allocate your assets and how you should structure your portfolio.
I guess it goes without saying that down is not up from a market's perspective, right?
Absolutely not.
It's not a good regime.
It's not run for the hills.
No, but we're getting there, right? So it is a fairly nasty regime to tackle. I can guarantee you that if you want to buy a poster of this chart and put it on your wall, then it looks like a painting, right? Rather than, but the point is, when you look at returns during the so-called down scenario, we're not talking good returns in equities, rather the opposite. We're not talking good returns in commodities, rather the opposite. And especially everything linked to China is very sensitive to this. So you need to be net short commodities, net long dollar. If you're based in the US, you can obviously buy added exposure to the dollar via various solutions. So I think those are some of the things that will work in September. It's not going to be easy to make a lot of money on the long side of things.
No, absolutely. You can check out all our models on at stenoresearch.com. We do articles where we explain this a little bit more. We have a data hub where you can play around with this essentially. But this is the core at the core of our thinking. So we'll try and include more and more of that. Just one more snippet from our models, Andreas. This is something we haven't brought up too much. Value gaps.
Yes.
We also have a PCA tool running to detect value gaps in markets. We do this on equities, on rates, on FX, etc. I just brought in the equity one here, and this is advanced stuff, but on the other hand, it's very, very actionable. So could you just explain us what does these numbers mean when the UK industrials have a fair value gap of 1.76?
We're looking at standard deviations here. Mm-hmm. So we're close to 2 standard deviations away from the fair value in this macro model.
Historically,
So we're basically talking about 10 macro variables trying to predict the fair value of right about every asset on Earth in this model. And right now, in equity space, the most expensive equity index out there relative to the macro landscape is Thailand. It's set 50. In all honesty, it's not really a market that I've traded a whole lot. But it's kind of interesting because Thailand is typically a high beta market to China. So this is also sort of a symptom of Chinese linked assets being overvalued relative to what we can gather from the macro economy right now. Also worth noting that we have industrials, we have SPX materials, so the materials sector fund in the S&P, high on this leaderboard, meaning that they're expensive relative to the macro landscape. At the same time as we have consumer staples, healthcare in Europe, high on this list of expensive equity sectors and equity indices relative to the macro landscape. So everything is expensive.
Yeah.
I mean, both cyclicals,
that's the main takeaway
defensives, here, various regions, except Erdogan and Turkey, flagging as cheap. Be my guest to buy Turkey. I'm not really sure. Unless you want to get stuffed early this year, and whether you should buy Turkey, if you know what I mean. So, at least it's not a market that I've had a lot of luck trading. So, I don't know whether it's early Thanksgiving in the MSCI Turkey Index here, but it's flagging cheap versus macro. So and interestingly, actually since 2020, it's been a very reverse market relative to what we've seen elsewhere. It tackled the inflation crisis very well, that Turkish equity market, and it's up I think 15% measured in dollars this year. So maybe I need to get accustomed to trading Turkey a bit more.
I don't know. Anyway, the way we use this is obviously not bulletproof. It has a relatively good hit rate, but the way we use this is sort of as you say, to flag certain areas. We say, could this be an interesting trade? And then we, of course, perform all the needed due diligence on that. We will probably not enter the portfolios we run into Thailand or Turkey, because that's probably not our areas of strength. But it does flag some interesting trades that you can then look more into. So that's what we're trying to give you some ideas on here. And obviously, it's very telling that they're all in positive territory, which means they're historically priced too high from this model. Very, very interesting, Andreas. Very, very actionable as well. One last topic I just want to touch upon. Oil. We haven't talked too much about oil for the past weeks, but we did an article on this Tuesday, was just released, where we're essentially looking at what's the future strategy for OPEC, because we are anticipating that in the coming days we will see some kind of a decision from OPEC on whether to continue the production cuts or to essentially hike production. Based on all we've just talked about, it seems to me would make very, very little sense to increase oil production right now, with demand in China being slow, etc. But that might actually be the way they're going. That's the base plan essentially. Yeah,
that's what they've told us. It seems like they're stuck in internal discussions on whether to follow that plan right now.
Essentially,
Was it just a few days ago? We had a few sources telling Reuters that they could decide to go ahead with these increases to the supply, but
in my view, if they do increase supply, it has nothing to do with market conditions, because that would simply make no sense. At least supply and demand conditions. It would either have to be politically driven, i.e. pressures from either China or the US, or it could be driven by something like this chart, which shows you the crude oil production of OPEC versus non-OPEC countries. So essentially, ever since OPEC started or reopened this cutting cycle, they have lost a lot of market share essentially to non-OPEC producers, mainly the US, Canada, etc. At some point, OPEC will have to do something about this, because, I mean, they can keep the oil price high, but the main benefactors of this are obviously US oil producing. So at some point they will have to simply increase their production, pull up more oil to sell. So there's this underlying trend.
But I mean, I guess the headline of this chart is that OPEC is losing relevance by the minute.
And that's the other thing here. Can you maintain a what's essentially a price cartel with 27% of the market share? No, you can influence the market, but you can't control the market, perhaps. And that's obviously, whenever they cut their production, they're putting a time limit on their, or they're decreasing their power over the market as well, because other producers will simply step in. So that's sort of the catch-22 here.
Mikkel, as a disclaimer for the audience here, we have to admit to them that you've been completely off on the oil price ever since you bought an EV.
Completely.
And when you bought that EV, you stopped having like the feeling with the oil market, right?
Absolutely.
So allow me, as I drive a gasoline car still.
Absolutely.
I'm kind of left with the vibe that the oil price could see some material downside here. Unless they truly get together within the OPEC group and tries to alter this picture from a supply perspective. And if we flip to the next chart, here's what could happen. We've seen quite a few times since especially the pandemic, OPEC disagreeing on the direction of travel, not necessarily in their rhetoric to the outside, but in their de facto production numbers. And we've seen how the Saudi Arabians every time there is a lack of coherence basically within the OPEC group, that they need to call for a meeting, and they try to get everyone together, and then we see some cooperation over the next, say, I don't know, 12 weeks or so, and then everything falls apart again. Yeah. And everything has fallen apart again.
Absolutely.
So here is the correlation between the production numbers
between Saudi
Arabia and the rest. So when Saudi Arabia brings down production, the rest of the group says, hey, thanks. On average, we're increasing, right?
We'll take over those orders. Yeah. Essentially.
So I don't know whether OPEC even practically exists anymore. At least it's a very volatile cartel now. Yeah. And the things they agree upon, they don't necessarily agree upon them in practice.
No. And there is certainly a time limit on the power of OPEC and thus the power of Saudi Arabia to influence oil markets, definitely. And that is also driving a lot of the developments in the Middle East. We've covered that on other topics, and we will continue to do so. But just an interesting little sneak peek into OPEC and what could be upcoming decisions and announcements from them.
And this is obviously the reason why they're trying to buy all your golf players.
Yeah, essentially.
And it is.
Exactly. Exactly, because Saudi Arabia knows that their power base, which is currently very much tied to oil, that's running out. That entire play is running out. So they need to be strong in other fields. They need Western investments for their mega city projects, etc. And they're basically trying to build another Dubai because they missed that train as well. And that's driving a lot of the developments in the Middle East, including the Gaza war.
And one thing you're not going to get bombed by the US if Brooks Koepka is putting for birdie.
Very much true. Right. Very much true. Yeah.
And that's why they're doing it.
Absolutely. Yeah. Take note, North Korea. Essentially. That's pretty much what we had this week, Andreas. Anything left for the listeners?
Yeah. So, I mean, in full transparency, we're leaning short commodities. We have a pretty firm bet on silver going lower. We think the dollar is a value trade in a positive sense through September. We find the dollar versus the Singapore dollar to be the best expression of that right now. And then we're considering whether to add to negativity via shorts in the equity space. I think the U.S. market looks a little bit more vulnerable than other Western peers. So those are sort of the market considerations going into September here. I think it will be a very tricky month to make money during. If you're long stuff, basically.
Absolutely. Check out all our research at stenoresearch.com. We'll see you next week.
Sometimes it may be good, sometimes it may be shit.
It's a brilliant, brilliant event, and you'll come away with lots of new ideas and a better understanding of this incredible exponential world. You get to speak to the smartest people like you trying to figure this out, but also the people on stage. They're the experts. So we get all of that, all in one place, in Singapore. What more can you ask? See you at Token 2049.
Hey there, revolutionaries. To join a community sharing insights like you just watched, head over to realvision.com. There you will get unbiased insights and exclusive access to the very best, brightest, and biggest names in finance. Be a part of our community of lifelong learners. See you there.